Chapter 16, Lost Transactions, Part 2. As we explained before, even when a loss is allowed otherwise under Section 165, it may be disallowed by either statutory provision or a judicial doctrine or judicial limitation. Some of the statutory provisions that may disallow a loss that would otherwise be allowable under Section 165 are listed here on the slide. Some have been explained before, and some will be explained as part of this chapter. These provisions consist of the related party rules under Section 267, wash sale provisions under Section 1091, straddles under Section 1092. All three of those concepts will be discussed in the next few slides as part of this chapter. The limitations may also be under Section 274 pertaining to meals, entertainment, and recreation, which was covered in a previous chapter, or hobby activities under Section 183, also covered in a previous chapter, and home office deductions and vacation rentals, also discussed in a previous chapter. Other statutory limitations may be the at-risk limitations under Section 465, passive activity limitations under Section 469, and capital losses, and all three of these limitations will be discussed in later chapters in this course. The first of the statutory limitations we discussed was the related party rules under Section 267. Specifically, Section 267A1 states that loss on a transaction between related parties is disallowed. And this provision does not only apply to bogus or sham transactions or those that have a substance that's different from their form. It also applies to a bona fide transaction driven by business reasons. A gain on a transaction between related parties must be recognized. So if there's a sale between related parties of a bundle of assets, some of which are sold at a gain and the other ones sold at a loss, this sale must be separated out, and the purchase price for the acquisition of those assets must be allocated among the assets, and the sales that result in a gain, of course, will be recognized, and the gain will be recognized. The sales that result in a loss, since it's occurring between related parties, the loss will be disallowed. In a related party situation, the basis of the seller does not transfer to the buyer. The buyer's basis and holding period start fresh. Therefore, the disallowance is in effect permanent. The only exception to this rule is if that related party buyer subsequently sells that property to an unrelated party at a gain, then only the amount of the gain that exceeds the previously disallowed loss is recognized. And this provision applies not only to recognized losses but also to a deferred gain. So if the gain, the subsequent gain by the related party results, so if the subsequent transaction by the related party results in a gain that is deferred, for instance under Section 1031, that deferred gain is also reduced by the amount of the loss that was previously disallowed. And finally, this rule does not apply to transactions occurring between spouses, between a husband and wife. Those transactions are ruled by Section 1041, which states no gain or loss is recognized on a transaction between spouses, and the basis carries over from one spouse to the other. Here is an example demonstrating what happens in a related party transaction when the property is sold at a loss between related parties. And this example has situations that covers just about every situation in a subsequent sale by the related party to someone else. In the example, A buys property for $100 and sells it to B, a related person, for $75. So A has a loss of $25. That loss is disallowed under Section 267. B's basis is $75. Starts fresh. If B sells that property to an unrelated party for $70, B recognizes a loss of $5 based on his new basis of $75. If B sells that same property to an unrelated party for $90, however, then he recognizes no loss because he has a gain. However, B recognizes no gain either because his gain of $15 doesn't exceed A's disallowed loss of $25. So in this situation, B recognizes neither a gain nor a loss. If B sells that same property for $110, he recognizes a gain of only $10 because his realized gain is $35 based on his basis of $75. However, only the portion of that gain that exceeds the previously disallowed loss of $25 is recognized, and that is only $10. In all three cases, B's holding period starts fresh on the date of his purchase from A for the purpose of determining whether, if that subsequent gain or loss is a capital gain or loss, for the purpose of determining whether it's a long-term capital gain or loss, his basis starts on the date of his purchase from the related party A. And keep in mind, even though the slide says that B's sale is to an unrelated party, in a situation where there's a gain, it wouldn't matter because the gain would be recognized and would be subject to the same reduction of the previously disallowed loss. However, in situation 1, when B sells property for $70, if the sale was to another related party, then of course B's loss of $5 would also be reduced to 0 and disallowed. So here's the definition of related persons. The following members of a family are related: brothers, sisters, spouses, ancestors, and lineal descendants. Furthermore, a corporation and a shareholder are related if more than 50% of the total value of the stock of the corporation is owned directly or constructively by the shareholder. And finally, certain trust relationships would fit under the definition of related party under Section 267. Those situations are listed on the slide. In a sale that is made to two parties jointly, one of whom might be a related party and the other one not, that sale must be fragmented and the related portion is subject to the related party rules. An example of this would be a sale to the taxpayer's son and daughter-in-law, which consists of a sale to two joint tenants, one of whom is a related party, the son is a related party, the daughter-in-law is not a related party under the Section 267B definition. And so that sale must be bifurcated. If it's sold at a loss, the loss for the portion that's deemed to be sold to the son will be disallowed. The second of the statutory limitations on losses that would otherwise be allowable under Section 165 is Section 1091 of the wash sale rules. It states that no losses otherwise allowable under Section 165 are allowed on sale of stock and securities if during a period beginning 30 days before and ending 30 days after the sale, the taxpayer enters into a contract or option to acquire substantially identical stock or securities. So in a situation where the taxpayer sells stock where either 30 days before that sale date or within 30 days after, the taxpayer purchases identical securities or gets into a contract or an option to purchase those identical stock or securities. Obviously, this rule is meant to prevent taxpayers who are sitting on a stock with a built-in loss from selling it, recognizing the loss, and then buying it right back within approximate period of time. For the purpose of determining the dates, the trade dates control, not the date that the taxpayer gets into an agreement or the settlement date. However, for a short sale, the date when the short sale contract was entered into controls, not when the stock is actually delivered. This is under Section 1091 regulations. If the taxpayer owned or had a contract or option to purchase the short sale shares at the time he entered into the short sale contract. So once again, if the taxpayer enters into a short sale contract to short sell shares that he already owns, then for the purpose of Section 1091, the date the taxpayer enters into the short sale contract is the date of the sale. It's treated as the date of the sale. To explain a little further, in a short sale, you're selling stock at today's price that you don't own. Normally, this is how a short sale works, hoping that the price will decline so that you sell the shares at today's price, promising that you will deliver the shares back either to a brokerage house or to some other investor at some date in the future. If at some future time, by the time that you're delivering the short sale, the shares that you don't have at the time that you purchased them, the price on those shares has dropped so that you can purchase them at a lower price and deliver them at the contracted price, you have made a profit. And your profit is the difference between the value of the shares as of the short sale date, the date they're delivered, and the short sale price, which would have been the price at the time you entered the contract. So what this rule says under regulation section 1.10 1091-1G is that if the taxpayer enters into a short sale contract for shares that he already owns. So with this rule under regulation section 1.1091-1G says is that if the taxpayer enters into a short sale contract for the short sale of stock that the taxpayer already owns at the short sale date, then for the purpose of this section, the date that the taxpayer enters into the contract counts as the transaction date, the sale transaction date. So that if the taxpayer either within 30 days before or within 30 days after that short sale date purchases that same stock, then the rules of section 1091 kick in and any loss on the short sale will be disallowed. Similar rule applies when a short sale, if within the statutory period, that 30-day before and after date, the taxpayer sells substantially identical stock or securities or enters into another short sale agreement for substantially identical stock or securities. So this rule is different from the rule that we discussed above. This says once the taxpayer has a short sale, not the type of short sale that fall under the regulation 1.1091-1G, where the taxpayer already owns the stock, but the taxpayer gets into a regular short sale contract and finishes a short sale contract, perhaps at a loss, and then within that statutory period, either 30 days before or 30 days after the short sale closes, because under this circumstance the transaction is deemed to have occurred when the short sale actually closes and the taxpayer has delivered the short sale shares. Then if the taxpayer purchases the same stock or gets into another short sale agreement for that same stock or substantially identical stock, then the rules would kick in under section 1091 and disallow the loss on the first short sale. So this is rather complicated. I may have confused you. Think it through, read the code sections and the regulation sections. If you need to, and think about it, if you need to discuss this in class, please bring your questions to class and we will discuss them by examples. Finally, there's another rule. If either the sale or the purchase is made indirectly by the taxpayer, the wash sale limitations also kick in. For example, there's a revenue ruling 2008-5 where the IRS ruled that when the taxpayer sells some securities and causes his IRA or Roth IRA to purchase those same securities within that 60-day statutory period, the loss on the taxpayer's sale is disallowed. Here's a definition under the wash sale rules. A substantially identical security consists of stocks of the same company with similar voting, liquidation, and dividend rights, and start over on the slide. Here's the definition of substantially identical securities under section 1091. Stocks of the same company with similar voting, liquidation, and dividend rights. A convertible security is substantially identical to the securities that they convert into, or the securities that they acquire at conversion. Securities of different companies are not substantially identical, even if they're in the same industry, unless the companies are affiliated or they are substantially identical in other respects. Under Section 1091D, basis of securities purchased is equal to the basis of the securities sold adjusted by the difference between the price at which it was acquired and the price at which the substantially identical security was sold. In effect, mathematically, this has the effect of tacking on the sale that was disallowed in the wash sale to the basis of the new securities that were purchased. Here's an example to demonstrate the wash sale principles. The taxpayer owns securities with a basis of $1,500. He sells his securities for $1,000, and within 30 days of the sale, he purchases identical securities for $1,200. Discuss the tax consequences. Take a moment to work through this example, and we will go through the solution in the next slide. You can turn off the lecture if you need to. So here's a solution. Recall the taxpayer owns securities with a basis of $1,500 that he sold for $1,000, and within 30 days he purchases identical securities for $1,200. At the time of the original sale, he has a $500 loss. However, because he purchased identical securities within 30 days, that $500 loss is disallowed under Section 1091. And the basis of the securities purchased is computed as follows in the formula that's given in Section 1091D. The basis of securities sold was $1,500. The difference between the sale price of the old securities and the purchase price of the new securities is $200. Therefore, the basis of the securities purchased is $1,700. As you can see, since the new securities were purchased for $1,200, instead of taking their acquisition price as their basis, which was $1,200, they also have an additional $500 tacked onto it, which was disallowed sale on the old securities, and their basis is going to be $1,700. And as we discussed before, the holding period of the old securities tacks on to the new securities. So in effect, it's like the wash sale never occurred. The next statutory limitation we're going to discuss are tax straddles. And even though the topic of this slide is straddles, which fall under Section 1092, the slide actually discusses two provisions, Section 1256 contracts and Section 1092, which applies to tax straddles. And the reason for that is, as we're going to see, is that the two sections sometimes interact. First, Section 1256 contracts are referred to certain types of contracts, such as regulated futures contracts, foreign currency contracts, and non-equity options, or equity options held by a dealer. These types of contracts must be marked to market on the last day of the taxable year. So in every taxable year, the unrealized gain or loss on these contracts during the year must be recognized. and the gain or loss by the provision of the statute are treated always as 40% short-term and 60% long-term, regardless of the holding period of the securities or the commodities under the contract. Section 1092, different code section, applies to all tax straddles, contracts of offsetting positions. For example, a contract for a call and put option on the same stock. Under Section 1092, any loss realized on a tax straddle is allowed only to the extent that they exceed the unrealized gain on the offsetting position of the straddle. What this means is, since a straddle contract involves two opposing contracts going in the exact opposite direction of the other, a call option on one stock and a put option on the same stock. If the taxpayer has a contract like that, and during the year the taxpayer exercises his put option and loses money on that, that loss is disallowed except to the extent of the gain, the built-in gain on the call option. Contrary to what you might expect, that disallowed loss is not deferred indefinitely or until the offsetting position is sold. It's only deferred until the following taxable year, and it is treated as sustained in the following taxable year. But what this does is, because of the fact that a straddle contract gives the taxpayer the opportunity to perhaps take a loss as a short-term loss and defer the gain until the following year, until it becomes long-term, so that it has perhaps a short-term capital loss in one year and a long-term capital loss in a subsequent year. By doing this, the statute in effect turns that short-term capital loss into a long-term loss by making the taxpayer pick it up in the following year. We will discuss Section 1092 and Section 1256 contracts again in the context of capital gains and losses. However, the significance of the interaction between the two is, if at one or more of the legs of a straddle is a Section 1256 contract, then Section 1256 principle applies first, that mark to market. And if, as a result of that marking to market at the end of the year, there's a net loss, then that net loss will be subject to the Section 1092 rules and limitations as well, so that the loss on the mark-to-market, for instance, would not be allowable except to the extent of the unrealized gain on the offsetting position, and any additional portion of the loss will be deferred until the following year. And so, to the extent that the disallowed loss consists of that 40% portion of the mark-to-market loss that is short-term loss, by being deferred until the following year, first of all, it cannot be recognized in the year of sale, and the recognition is delayed by 1 year. And furthermore, by being treated as realized in the following year, it becomes a long-term capital loss. The final statutory limitation on losses is under Section 165 itself. Section 165D states that gambling losses are only allowed to the extent of the gambling winnings. This provision applies to all types of gambling, whether recreational gambling or for the activities of a professional gambler. Of course, for a professional gambler, that gambling can be shown to be a trade or business, and therefore the wins are reported as income, and the losses offset that income, and the net income is the taxpayer's net income from that activity. For a non-professional gambler, the winnings are all reported as income on the return, whereas the losses are only reported as miscellaneous itemized deductions. So they would benefit the taxpayer, first of all, only if the taxpayer itemizes, and then they're subject to that 2% floor limitation for 2% floor limitation for miscellaneous itemized deductions, and they are treated as a preference for alternative minimum tax purposes. In this vein, for a non-professional gambler, cut it out. Disallowed losses, the losses that are disallowed in one year cannot be carried over to another year or to be used against the winnings of other years. And in fact, for a non-professional gambler, each win and loss should be reported separately, so that if the taxpayer goes to Vegas one day, wins a whole bunch of money, comes back, and 6 months later goes to Vegas and loses everything that he'd won the first time and more, the win would be reported as income on his 1040 as a separate item, and the loss on the second time would be reported in total as a Schedule A miscellaneous itemized deductions. So the win wouldn't wipe out, the loss wouldn't wipe out the win. In reality, a lot of taxpayers do net the events out, especially when the events happen within the same proximity. For example, if a taxpayer goes to Vegas for the weekend, normally if they have a win, they would report the net win, and these are for the taxpayers that are compliant. They would report the net win by offsetting the wins against the losses, or the net loss. So for example, if the taxpayer goes to Vegas, normally if they would report either their net win or net loss for the trip, as opposed to keeping track of every win and every loss and treating them separately.